Death and taxes, two things that are guaranteed in this life, right? And while taxes do unfortunately play a big role in investing, there are steps we can take as investors to help reduce our overall tax bill every tax season. Now, one of the most underused investment strategies by far for helping lower your tax bill is a method called tax-loss harvesting. It's established, it's effective, and best of all, with the right Robo-Advisor, it's all completely handled for you with no additional effort on your part. Now, one of the first reasons you may want to consider adding a Robo-Advisor to your investment arsenal is simply for their investment automation features. I'm talking about features like automatic portfolio rebalancing and tax-loss harvesting. You see, the convenient thing about these types of automation features and strategies is that they're not something that you have to do on your own, because with the right Robo-Advisor like Wealthfront, it's all handled for you automatically. Now today, we're going to be breaking down what tax-loss harvesting is, how it works, and how it can ultimately save investors like you and me a lot of money in the long run. Now, I'd like to thank Wealthfront for sponsoring today's video and providing me a product demo of their app so I can share with you all the features of tax-loss harvesting in action. So let's get right to it. So for starters, what is tax-loss harvesting? Well, tax-loss harvesting is not a new trend by any means. It's been around for decades, and historically, it's a strategy that was used by financial advisors of the wealthy to help reduce their overall tax burden. But luckily for us, with the rise of robo-advisors in recent years, any investor, no matter your account size, can take advantage of all the tax benefits it has to offer. You see, tax-loss harvesting is a strategy that takes advantage of movements in the market to help capture investment losses. So how does tax-loss harvesting actually work? Well, in the case of Wealthfront, they actually have an algorithm-based tax-loss harvesting software that monitors clients' portfolios daily to identify potential losses. And when you have an investment portfolio on the Wealthfront platform, it's composed of various ETFs and funds. And when an eligible ETF in your portfolio loses value, Wealthfront then sells the ETF for you at a loss as long as this loss meets specific thresholds met by their algorithm model. Now, these losses can then be used to offset other investment gains or ordinary income, which again helps lower your overall tax bill come tax season. But tax-loss harvesting doesn't stop there, because in addition, if an ETF is sold at a loss, Wealthfront will automatically replace it with another closely correlated ETF. As a result, guys, your portfolio's risk and return profile, it remains unchanged, all while still generating you tax savings. And like I said, guys, these tax savings can then be reinvested back into your portfolio to further increase its value and help it grow even more over time. Another important thing to know is how does Wealthfront actually go about selecting these alternative ETFs for your portfolio through their tax-loss harvesting feature. So as I mentioned before, when an ETF in your Wealthfront portfolio loses value, they will then sell that ETF for you at a loss to again capitalize on this loss for tax purposes. Now, as a result, after that, they will then choose and buy an alternative ETF for your portfolio to replace that one they just sold at a loss. And these alternative ETFs offer similar historical returns, comparable volatility, and similar expense ratios to the initial ETFs. In addition, and this part is really key when it comes to tax-loss harvesting, Wealthfront also makes sure that the new alternative ETFs track different indices to avoid what's called the wash sale rule. And that's because wash sales are something you definitely want to try to avoid. Now, a wash sale occurs from the sale of an investment when a substantially identical investment is then purchased within the 30 days before or after the original sale date. So when it comes to tax-loss harvesting, guys, wash sales are something, like I said, that you want to try to avoid in order to fully take advantage of the benefits of tax-loss harvesting. The reason for this is not because wash sales are illegal, they're not illegal, but the IRS generally prohibits claiming losses on wash sales. So again, try to avoid it if possible. And while trying to avoid wash sales on your own would be extremely time consuming, that's one of the benefits of using a robo-advisor like Wealthfront. Their algorithms and softwares are able to prevent this by closely monitoring both the sale and purchase timing, and most importantly, by ensuring that the new alternative ETFs they select, that they aren't substantially identical to the initial ETFs that were just sold. Now, if you're wondering which account types are eligible for tax-loss harvesting, it's actually only available for taxable investment accounts. It's not available for tax advantage accounts. And the reason for this is because tax advantage accounts are retirement accounts like Roth IRAs, IRAs, and 401ks. Gains and losses in these types of tax advantage accounts are already not taxable, so there's no need for tax-loss harvesting there. But if you have a regular investment account, a taxable account, which is basically any non-retirement account, that is eligible for tax loss harvesting on Wealthfront. Now, when it comes to fees, Wealthfront's tax loss harvesting feature is available to all its clients and users at no additional cost. This is because all their investing automation features are already included in their annual advisory fee, which again is 0.25%. And according to research on Wealthfront's website, their tax loss harvesting service can often generate savings of at least 3 times their advisory fee for clients using their classic recommended portfolio. And when it comes to paying your taxes, Wealthfront provides you everything you need to file. Because every tax season, Wealthfront provides you what's called a Form 1099 that can be attached to your annual tax return. It will contain all the relevant buys and sells in your Wealthfront accounts, as well as all those made by tax loss harvesting. So if you would like to try out Wealthfront's automated investment portfolios for yourself and begin taking advantage of their tax loss harvesting feature, my friends over at Wealthfront have been generous enough to offer viewers of the everyday investing community a special promotion where you can get your first $5,000 managed completely for free on their platform. So if you want to take advantage of that, be sure to join through the link below in the description box. So let me know what you think of Wealthfront's tax loss harvesting feature down below in the comments. If you enjoyed this video, be sure to check out some of my other Wealthfront investing and tutorial videos right here. Or feel free to check out this other video that YouTube recommends right here. As always, thanks again for watching, and I look forward to seeing you in the next video.